Well, Peter, there's nobody who really understands this investment on our team quite like you. And I go back. This was an investment we when we were our initial shares purchase, right? I'm sure you have those details.
Um, well, initially we went with the preferred stock, and then the common stock dropped down to about $3, and that was in 2017 where we started making some positions just under $3. And we didn't do anything with it for a long time, but uh, it was trading in the $1.50 to $2 range for a long time. Uh, and of course, during the initial Trump administrations, it jumped up, but then it backed off. So I think the Fannie Mae preferreds went up to $10 or $11 on his first administration, and then backed all the way off to about as low as $1.50, I think. Um, 2023 was probably the really dark period for most of these investments, but it gave us an interesting opportunity. Is that we were able to buy in 2023 at under $1, and then at about 70 cents, and then in many situations at like 42 or 43 cents. And the reason we were able that we did that was we had some large gains in NVIDIA sales, and so I would take a portion of that and put it into um, the Fannie Mae common. But one of the key things with the value investing, especially in the deep discount value investing, is just because something has gone from, like Compass Minerals, the fact that it went from 95 to 15 does not mean it can't go to 7. And that's exactly what we experience here. Um, Now, this investment has taken forever to unfold, um, and so, but adding to those positions, and actually probably more importantly in the preferred, because the preferred is a contract, and the chances of that being successfully paid off from all the readings we've done is substantially higher than the outcomes that's expected in the common, which Dom has talked about in the sales when the email that it's gone out to clients. Um,
Um, why don't we backtrack just a little bit too and talk about like what the original thesis with the Fannie Mae, like whether it be preferreds or common, what we're seeing, what we saw in the beginning and hoped would happen, like the original thesis, and then we'll get an update on kind of where we are today after that.
sure. The We originally came to us and a couple of things. We had seen articles of Bruce Berkowitz um, having a position, and also Third Avenue Management had a position, and the uh, that's where it came to our notice. They uh, Fannie Mae was part of had a significant bailout in the financial crisis of 2008, 2009, to the tune of over $100 billion. And they then went into conservatorship, and they had an agreement there that Fannie Mae would pay back their money that they owed at 10% interest, plus the government would have an option to buy 80%, almost 80% of the business at almost nothing per share. Um, and Then it became clear from various lawsuits that Fannie Mae was winning against major banks that had sent them poor mortgages and such, that Fannie Mae was going to be incredibly profitable. The Obama administration and others didn't want Fannie Mae to survive, and so they forced Fannie Mae to change the agreement to say that instead of paying us 10% interest on the money you owe us, give us all your profits in perpetuity, which they was called the net worth sweep. And our thesis was that that net worth sweep was unconstitutional. As a conservator, you violated your role as conservator, and that would ultimately be overturned. Our anticipation was that would be resolved at a much sooner pace than it has. The Democratic administrations historically have kind of didn't really care to resolve the Fannie Mae situation, but President Trump in his first term in office had that as a priority. Shortly after his election, those preferreds and the common appreciated significantly. But there was Trump administration was then marred by potentially other things that kind of took over, an impeachment process that was going on and such, and so he never got to it during that term. Fast forward with his second term, as soon as he was elected, that's clearly a priority, and he had been working on it as a priority, and they've talked about the idea of they thought they potentially could have even an IPO on the common stock before the end of 2025, which didn't happen. And we've also been in a period of a very quiet time right now where not much has been announced on their behalf. So the reason for selling the common is that we are taking the more conservative route, and we still have a huge position in the preferred shares. And so from a portfolio management standpoint, we decided to take some money off the table. Dom, you had also done a purchase a few years ago on the common, so maybe you want to talk a little bit about that.
Yeah, I mean, it's very similar to your rationale. It appeared to be a focal point of this current administration's objective is to release them from conservatorship. When we bought the commons, it was, I think, somewhere around $2.50, $3. And it was maybe a week or two after he was elected president, and the stock was still being priced as if it had a low as if the Fannie Mae commons and just the overall organization had a low probability of exiting conservatorship over the next couple of years. Based on everything that we read, his objective, if the market was pricing in a 20% odds of Fannie Mae exiting, we thought there was over, maybe a 50% chance of exiting. And when you run the analysis at different valuations of the common stock, based on what leverage they may need to maintain or what the amount of equity they needed to raise was, we just got to a probability weighted outcome where the stock price, should they exit conservatorship based on where the odds are today, the stock should have been much higher than where it was. And so it seemed like a good risk reward at the time. And this was after we already knew Trump was going to be the president. So we thought the odds were still well in our favor, while the stock moved a lot, but in our opinion, not enough to adjust for the updated probability.
So the last couple of years, I've been doing a report that has our top performing investments. And in 2024 and 2025, Fannie Mae Common was the number one investment. And in both cases, it was up about 250%.
I believe in one of those years, it was the best performing investment in the U.S. market. Is that accurate? Or is it
I'm not sure, because
top 10?
Many other reports that talk about the best performing companies, since Fannie Mae is not traded on the New York or American Stock Exchange, it's a pink sheet. They kind of view that as
excluded. Yeah,
it doesn't get placed on the list because it doesn't meet their criteria for the most part. So the on our with our clients, the cost basis that on this most recent trade, it's about a 5 or 6x investment. No, it's higher than that. I'm sorry. Yeah,
and
it's more like a.
Can I ask a question about the initial thesis?
Sure.
Yeah.
Because from the initial thesis, you said that the part of the thesis was the net worth sweep would be deemed unconstitutional. What ended up happening with that part of the thesis?
It appears now that we've had all kinds of lawsuits, and many of them, the judges has said basically that was not fair to put that in place, but they didn't overturn it, so it was never overturned. And as we stand right now, the government still believes, at least my understanding is, the government still believes that they're owed, that all that money that they received did not pay off that loan. That's where it stands at this point in time. So that's why it's a lot more risk on the common holders than it is on the preferred holders, because the preferred holders have a contract, and the stock is valued at 25 on that. So the chances of that being paid off in full, it's very, very strong. Just a matter of when that will happen.
Yeah, I mean, my answer to that, Dom, would be I think that was probably part of the thesis that evolved over time as we saw how those court cases were handled. I still believe it was unconstitutional, but I think what we've learned is that no judge was going to go out and say, hey, this is, that's a very hard position to hold. And despite that, we still saw there's a push towards privatization, and the preferred shareholders need to be, there are laws about how the preferred shareholders would be handled in that type of a situation. So again, going back to which is the riskier position to hold, clearly it's the common. It's always going to be the common, right? But the preferred stocks, I still feel that we have a contract that needs to be upheld in place there. Whereas I think even you've made some comments to me over the last couple of times that we've talked about it over the last year or so, that if you read the 10K of the company, it's clearly indicating to shareholders that there are risks to common shareholders in today's environment. Like maybe expand on that a little bit.
Yeah, I think right in the 10K, and it may have been a relatively new addition where in the risk section of the 10K of Fannie Mae's 10K, it says something to the effect of the government owns an 80% stake in this company, or has warrants to 80% of the company, and in the future they may choose to exercise these warrants, and the value of the current shares may not. You may not be owning a significant portion of the company, or the value of the company that you own in the end has a wide range of potential values. And so my interpretation basically was the government is going to find ways to maximize the value of their ownership stake, and how they end up doing that could be at the detriment of current minority shareholders.
And as the with the agreement that came in place in 2019 during the Trump administration, that allowed both Fannie and Freddie to build net worth, it was letting them build net worth, but it was still saying, but it was not saying that, it was not stating that that money was being paid back in by any stretch. So that's the big risk there. There was several documents that came out that are important in terms of our investment thesis. In 2020, the Office of Management and Budget issued a report, and it talked about the probabilities of various things happening, of payback on the preferred stock, and what the common value could be. And then they did a report last year as well, and all of those, the ability for the preferred to be paid off has dramatically increased, and the ability of the common to have value has also increased dramatically. But as Dominic had mentioned, the variety of outcomes are much more wide. Late last year, a number of companies talked about what they felt the value of Fannie Mae common was, and I believe most of the valuations came in between $5 and $20. So pretty wide range.
What do we think about, like, so I would classify this as a special situation investment, right? This is not was not a long-term compounder. It was not I mean, it certainly was a deep discount opportunity, but wasn't going to be held as a going concern in our portfolio. What do you guys think about that as a type of investment that we are willing to own, and like how does it fit into the mix of other investments in the portfolio? Like when you think about its position size, its diversification of the types of risk that we have. Talk to some of those points.
I can start. I think that was there was a part of the investment that I liked the most. It was Fannie Mae is uncorrelated to every single other position in the portfolio. So whether the market was up, down, sideways, Fannie Mae had no correlation to any other position in the portfolio. So in that essence, it was a very good portfolio diversifier. And the thesis, the outcome, it wasn't like we had some other bank or insurance or some other financial company that was predicated on Fannie Mae getting released from conservatorship. So I think that part of the investment was very good. And then on sizing it, there was always a chance that this company would never get released from conservatorship. And while the probability of that is likely very low, it should be, just based on the rule of law, it should be near zero. There was still that chance that something like that would happen. So when something has some percent of being a zero, you can't make it the largest position in your portfolio, because that would, in the event that left tail, low probability outcome occurs, any compounding is basically destroyed. Any compounding of value is destroyed because of that. So Pete, I'll let you take over from there.
Yeah, I mean, one of the things was Fannie Mae as a business is one of the most profitable businesses in the world, and we were buying it for a fraction of that value. We've had a number of investments over the years that the triggering event that unleashed the value was a lawsuit. And that was the case with Qualcomm back in 1999. It was a very important piece with the lawsuit with Intel and NVIDIA back in 2009. And so this was another one of those things that, and of course, we had the same situation with Qualcomm with the antitrust suit back in 2017, and ultimately released from that in 2019. So this was like you said, a special case, and in the special case, in my opinion, this is how the outcome of a lawsuit that we believe, as Dominic had mentioned, the probabilities of a positive outcome were worth the fact that that's why we decided to invest in them. We felt that that possibility was there. And of course, as Dominic had mentioned, the correlation to other investments in the portfolio was near zero.
Well, why don't we kind of like wrap this up with what would we say we learned, or what did we discover in the process of owning Fannie Mae that will help us in the future with evaluating and understanding other investments that might fall into the same type of category?
You know, some of the things I felt is that we stuck to our guns of, we had a thesis that we believed would play out, and so we were able to hang on to it, even though that period of time extended longer. We definitely benefited tremendously by adding to our position when it went against us, and the so those are the two major scenarios I think we learned from it.
I think for me, something I've said several times is a position sized appropriately can outweigh any negatives that have occurred along the way. I mean, we talked about this position taking maybe twice, three times. I don't know how much longer than we initially thought. And even in that, the position has been a tremendous success, but along the way, it's felt like a failure several different times. But the fact that we did not oversize the position, that may have caused us at times to be forced basically to get out of the position because we just can't handle the volatility, or clients can't handle seeing a certain size loss in their portfolio. I think that's where I kind of come out to, if you buy a stock cheap enough with odds on your side and have the ability to hold the security for a long time, assuming your thesis is right, eventually you will be rewarded.
For a very long time, it was not unusual to see a minus 70% number on your position holdings, and so I'm sure that it makes it very difficult for the financial planner with the conversations with clients and as to what's wrong with it, and the clients not having patience there. You're certainly fortunate when you have a portfolio where other things are doing well, and to stay with it. But if we had a difficult market in other aspects, I think we would have had clients kind of throw in the towel and leave us if you can't have a whole bunch of minus 70s on your portfolio sheet. But as Dominic mentioned, the portfolio size was almost insignificant, so it didn't matter. But with what happened with it, it showed that it was a very significant upside potential on it, and it worked out well.
I'll add some thoughts here because Pete, you and I, when we made our first investments in the Fannie Mae preferred stocks, and then have subsequently been adding to those, and then also making the decision to buy the common, and then persistently adding to it over time when the times were right. We shook hands when we made this investment, and we both agreed. I don't know if you remember this. We both agreed the real price we're going to pay with this is in patience, not with the cash that outlay, because it was such a cheap opportunity to own a fantastic business. And I think we probably underestimated how much patience we would have to pay into this one to really get the outcome. But on that like behavioral side, right? Those conversations that I was having with clients, and Grace, we were having these conversations at one point when you joined in with us as well with clients, was people would ask us what's going on with Fannie Mae, and the conviction was always there. And we didn't always have much to update people on. There was a lot of periods where there was just no status update, just volatility, right? And then it would peak when it became promising, and then tail back off down to lower levels. But the conversations did come up, and it was always we're taking a multi-year outlook. We're not really concerned if the stock does this, and then hockey sticks up at the end, which is exactly, if you look at the chart on Fannie Mae, what's happened. All the return has been delivered on the back end. So it's the lessons I've learned is, if you still believe in your investment and it's down 70%, add to it. And Peter, I think this is one of your most enthusiastic positions that, we do our top 10 list internally, and it's been on the top for so many, quarters that we create that list. So anytime money was coming in, I think you've been just disciplined adding to it. And that dollar cost averaging into the investment has paid major dividends for us as we've sold out of it. From our vantage point, diversification is not Monte Carlo analysis, modern portfolio theory, picking the right percentage of stocks and bonds. It's truly understanding the individual businesses that you own and building a portfolio with decidedly different risks in each of those positions. Any final thoughts you'd want to share on the Fannie Mae position that we closed out?
My thoughts is that, you know, we look for things that are unloved and unwanted, but we want them to be unloved and unwanted for the wrong reasons. And we need to be, if we're going to be differentiated from the rest of the world, we need to be willing to do things that other people are not willing to do and have strong conviction in our ideas. And clearly Fannie Mae and virtually all of our investments meet that criteria as well. And there's no doubt that, in my opinion, the play out of our investment thesis took a lot longer than we ever anticipated. But our conviction never went away, and that's part of our strengths as an organization. Is I think we have conviction in something, we stay with it. And of course, I believe that is to be true in so many other things in life too. If you can't see the light at the end of the tunnel, you're done. And I know that that's helped me throughout my life, is by being able to see the light at the end of that tunnel is what keeps you going.
Dom, how about you?
You get the odds on your side, I think, just over the long term, even if things don't play out exactly as we thought. I mean, they still have not exited conservatorship, so our thesis hasn't fully played out. But when the risk reward is not the same, we just stay true to our investment process and adjust, whether that's sell, buy more, or just maintain. But in this case, it's the risk reward isn't anywhere near as attractive as it was even just 2 years ago, and now it makes sense to find the next opportunity.
I think of this as a great, like a Howard Marks lesson that we learned, especially we're highlighted in the pandemic, is that stocks go down, like really out of favor, right? The discounts become deepest when uncertainty is high, right? And Fannie Mae is a perfect case of high uncertainty at many periods of time during our ownership. And when you have uncertainty, what you have is a wide range of potential outcomes. But as the potential outcomes narrow, right, like going back to the pandemic example, we knew months after the pandemic started that the range of outcomes was shrinking as they developed vaccines, as they shut everything down. But we didn't know if it was going to be 2 years or 2 months or whatever. But as soon as the knowledge that the range of outcomes was shrinking, right, and it was going to be okay, before anything even actually recovered for companies or in the markets, stocks took off.
Yep.
Right. And so what's happened with Fannie Mae is the range of potential outcomes has shrunk down. And so the stock has taken off. And we made money on the narrowing of uncertainty. And that's a good time. So we were in early on the uncertainty and out early, but it's a great recipe for being a deep discount value investor. Is as soon as things become more clear, the price changes and we want to be out. And I think that's a phenomenal thing to tell clients about what we're looking for in our investments. Is there's something going on. Like, you don't get a good price on a business if there's not something going on that's unclear. But that's why we want to know more about the business than almost anybody else would ever take the time to do, and get to know the people who are in charge of it and everything, like we do, so that we can have confidence that the issues will resolve eventually.